Imagine waking up in January 2026. Now hiring signs are in every factory window, yet your weekly grocery bill just spiked another 10%. The catalyst for this friction: Donald Trump has returned to the White House with an aggressive new economic agenda. The promises driving it are straightforward: sweep away corporate regulations and slash taxes to get cash moving fast. Behind the headlines, these policies act as a massive transfer of capital, effectively moving wealth from one sector of the American economy to another. On day one, the administration deploys its shock therapy, when goods cross the border, the exporting country does not pay the tax. The American company importing the product pays the tax. Because it acts as a tax, a tariff becomes an aggressive financial tool. It extracts money from one group of Americans to directly subsidize another. For domestic producers, this heavy shield against cheap foreign competition creates an instant windfall. America already employs 12 million factory workers, and this policy suddenly creates a vacuum for 1 million more. Steel mills and heavy industries that spent years struggling quickly fire up dormant production lines to meet the new demand. The momentum spills directly into the surrounding supply chain. With domestic factories humming, independent truckers and logistics crews log massive overtime hours just to keep up with the physical volume. This chart shows how fast the money moves. You can see a sharp 15% upward spike in manufacturing sales concentrated in industrial hubs across Ohio and Pennsylvania. For the sectors making and moving physical goods, this policy creates a distinct environment where demand is high, factory towns are revived, and overtime pay becomes the baseline. But that factory boom requires capital, and the cash has to come from somewhere. Major retail chains that rely heavily on imported inventory are immediately hit with severe supply shocks. When those retailers get hit with massive border taxes, they pass the bill directly to the shelves. Shoppers watch the prices on everyday items like electronics, clothing, and toys jump 7% almost overnight. We don't have to guess how the math shakes out. Scaling up the data from previous trade conflicts reveals the exact toll these extreme policies take on a normal household budget. This breakdown chart illustrates the hidden cost to the American shopper. Factoring in those higher prices across electronics, apparel, and daily household goods, the average family pays an extra $1,800 every single year just to maintain their standard of living. The sudden wealth pouring into American factory towns is being extracted directly from the wallets of everyday consumers. When ordinary families have to dedicate an extra $1,800 just to tread water, their discretionary budgets evaporate. Consequently, broad consumer spending drops. When households pull back on discretionary spending to cover higher costs, the retail and service industries see their foot traffic vanish. As businesses cut staff to offset the drop in revenue, nearly 2 million low-wage jobs in the gig and service sectors are placed at risk. The domestic service sector isn't the only casualty. Imposing heavy tariffs guarantees severe retaliation from foreign governments, especially major trading partners in Europe. As those retaliatory barriers go up, U.S. exports sink by 12%. This creates a devastating shock for American agriculture, crushing farmers in states like Iowa who rely entirely on selling their crops overseas. Shielding a steelworker in Pennsylvania inherently means sacrificing the livelihood of a soybean farmer in the Midwest and a retail worker in the city. This chart shows the contradiction of the overall economy. On one side, short-term economic growth looks solid at 3.2%, but that higher persistent line represents inflation, stubbornly locked at 4%. People are still buying goods despite the inflation, but looking deeper reveals how. That 4% line is masking a massive $18 trillion household debt bubble. American families are floating their spending on borrowed money. This structure is highly sensitive. If the central bank is forced to hike interest rates just once to fight off that lingering inflation, it threatens to trigger a cascade of consumer defaults. The 60% tariff replaces the old trade logic with a dual-class system, creating a permanent divide between the producers who gain from the wall and the consumers who pay to maintain it. In this new American economy, whether you are living in a golden age or a house of cards depends entirely on if your paycheck comes from building goods or buying them.